Getting a permit to build high-voltage transmission lines in major jurisdictions now takes anywhere from 4 to 10 years. That grid lag has established a hard limit on how quickly new data centers can be built. Software applications can scale indefinitely, but they have to run on something physical. We have reached a point where the bottleneck for artificial intelligence is no longer code. The constraints are entirely tied to the physical materials required for computation. Look closely at the dense internal piping of this extreme ultraviolet lithography machine. To etch next-generation chips at the nanometer scale, manufacturers need perfect inert atmospheres. At the same time, the graphic processing units running these AI models require massive amounts of high-bandwidth memory. Keeping those environments completely free of reactive gases and preventing hard drives from overheating requires a highly specific asset, ultra-pure helium. And that specific asset just suffered a severe supply shock. This is Qatar's Ras Laffan industrial city. In early 2026, geopolitical conflicts in the Middle East led to military strikes on this exact port, instantly knocking more than 30% of the global helium supply offline. The disruption quickly spilled into shipping lanes. Cryogenic containers were forced to reroute entirely around Africa. Liquid helium continuously boils off and evaporates during transit, meaning extended voyages result in massive product losses before the ships ever reach port. The financial impact was immediate. Major industrial gas suppliers declared force majeure and slashed volume allocations to their customers by up to 50%. This chart maps the fallout. With 30% of global capacity offline, liquid helium spot prices spiked from historical averages of $15 a liter to over $30, and in some cases, $55 a liter. Because AI expansion relies entirely on these materials, the most valuable investments over the next 12 months are the companies controlling these exact physical bottlenecks. Knowing that AI relies on physical infrastructure is only the first step. The immediate problem is figuring out how to actually execute the trade. Your strategy is entirely dictated by the brokerage app on your phone. The platform you use creates strict boundaries around which assets you are even allowed to buy. Retail platforms like Robinhood or Acorns limit you exclusively to major U.S. exchanges. If you want to trade microcap stocks on the over-the-counter or Toronto Venture exchanges, you are forced to use a full-service broker like Fidelity or Schwab. This creates a clear fork in the road. You have to choose between buying defensive, cash-rich legacy infrastructure companies or betting on speculative, pre-revenue microcaps trying to capitalize on the commodity squeeze. Before you allocate a single dollar to the AI hardware trade, your risk appetite and your portfolio architecture have to perfectly match the access your brokerage provides. Let's start with Category 1, the platform-constrained core. If restricted to a platform like Robinhood, your capital goes into established large-cap giants. Your defensive anchor here is Linde. As the largest industrial gas company globally, its highly consolidated distribution network heavily insulates it from localized pipeline outages. That stability is backed by a $9.9 billion contractual project backlog. A major portion of their billion-dollar electronics segment is dedicated to building ultra-high-purity gas plants directly for semiconductor foundries. Next to Linde, you have your primary growth engine, Micron Technology. Next-generation graphical processing units require immense memory bandwidth, making high-bandwidth memory a structurally constrained asset. Look at the sheer scale of a modern semiconductor manufacturing complex. To fund this level of expansion, Micron locked in 16 strategic customer agreements. That translates to a minimum of $100 billion in non-cancelable revenue, backed by $22 billion in upfront cash prepayments from their customers.
But there are trade-offs to large-cap investments. These are massive corporations. You are trading explosive overnight growth potential for contractual certainty. Look at this comparison matrix. The trade-off for that massive backlog is that Micron's near-term multiple expansion is capped. Its 10-day relative strength index recently hit an overbought 85, and executives executed nearly $90 million in open market share sales over the past year. These legacy giants lack the volatility to triple your money in a month, but those massive contractual backlogs and cash prepayments provide a definitive, safe valuation floor to protect your capital. There is a specialized, vertically integrated option trading on major exchanges, Space Systems, specifically Rocket Lab. Space-based AI infrastructure solves terrestrial grid limits by bypassing land permitting entirely. Satellites in low Earth orbit gain direct access to unfiltered solar energy for power and vacuum radiation for cooling. Rocket Lab recently agreed to an $8 billion acquisition of Iridium Communications. That deal brings in $495 million in recurring operational EBITDA, providing high-margin cash flow to fund Rocket Lab's capital-intensive projects. We update our matrix, and the trade-off is stark. When you buy into space infrastructure, your portfolio takes on binary execution risk. Everything rides on the successful maiden launch of their medium-lift Neutron rocket. Integrating space systems offers a unique growth lever for restricted brokerage accounts, as long as you are willing to stomach the all-or-nothing volatility of launch days. Now we leave Robinhood behind and move to Category 2, the speculative sieve. To access these assets, you must use a full-service broker that routes orders to the OTC and Toronto venture markets. This is where you find pure-play explorers like Pulsar Helium and Avanti Helium. These companies offer direct, unhedged exposure to the ongoing helium supply shock. They take different operational approaches. Pulsar drills primary, high-grade assets in Minnesota, hitting 8.1% concentrations. Avanti is trying to accelerate commercialization by minimizing upfront costs, actively leasing an already constructed processing plant in Montana. Look at the final row of our matrix. The severe trade-off here is cash burn. Both are pre-revenue microcaps running massive trailing free cash flow deficits. They have less than 1 year of cash runway left to hit production. Avanti operates with negative equity in subsidiaries and a market cap under $10 million. That subjects investors to intense, news-driven price swings. These microcaps offer asymmetric upside while industrial gas prices are surging. But if production timelines slip past 2027, you are facing near-certain equity dilution or total loss. The era of blindly buying software stocks is pausing.
Pricing power now lives entirely in the physical world, which means your specific execution strategy dictates your returns. This flowchart maps out your options. If you are using Robinhood or Acorns and you want to deploy a $20,000 portfolio focused on capital preservation, you follow the first path. We allocate 40% to Micron, 30% to Rocket Lab, and 30% to Linde. You don't chase OTC microcaps. This split safely captures memory growth through Micron, bypasses the terrestrial grid through Rocket Lab, and builds a defensive wall with Linde's industrial gas contracts. If you have a full-service broker and an additional $10,000 of risk capital, you take the second path. You allocate 60% to Pulsar Helium and 40% to Avanti Helium. With this path, you are purposefully trading away financial stability. You are buying a direct, high-beta pipeline straight into a geopolitical supply shock. Never buy a pre-revenue microcap expecting the stability of a $100 billion gas giant. Check your brokerage access, define your risk tolerance, and match your portfolio architecture to the physical reality of the market.